Howdy, y'all. Today is June 1st, 2025, week 3 of my vlog as a value investor. As you all know, I'm particularly dedicated to making returns in the stock market. You may be wondering, hey Thomas, how do you do it? Well, there's a few simple things to know, and that is you are buying a good or even great company at a discount or when it's undervalued, capitalizing on the correction of the market, which to my understanding can take quite the while. But if you've got the patience, it is well worth the time. Of course, it can be pretty tough sometimes to figure out if a company is overvalued or undervalued. So here's a few simple terms to help you figure out the intrinsic value. The PE ratio, or the price to earnings ratio. Basically, if you have a company valued at 1 billion and the company profits 100 million, then that is a PE ratio of 10. Or think of it like this: it would take 10 years for the company to make its money back. Typically, the lower the PE ratio, the better, but it isn't the only metric to go off of. There is also the growth rate of the company, indicated by its sales or its increase in net revenue annually. In that same analogy, with the $1 billion company at a PE ratio of 10, let's say the company is growing its income or profits by 10% annually. Then let's say 5 years from now, the company will be worth 1.5 billion with the same PE ratio. Congratulations, you just made 10% per the year. Now let's go a step further, and in that same analogy, we find a similar company with the same growth rate, but its PE ratio is half than its industry norm. Let's say at a 5 PE ratio, where the company is making 200 million a year with the same 1 billion valuation. And let's say we hold the stocks we bought in the company for 5 years. By then, the valuation of the company should correct itself back to its intrinsic value of 10 PE ratio versus the 5 PE that we bought it for initially. So with example 1, we bought a company at 1 billion that turns into 1.5 billion in 5 years, resulting in a 10% annual return. But with example 2, we bought a company at 1 billion. We bought a company at 1 billion because it was undervalued at half of the PE ratio. It went from a valuation of 1 to 3 billion in 5 years, resulting in a 33% annual return, tripling what we would have made simply because the price to earnings was at half of the first company. Now, this analogy is basically as simple as it gets. You can compare two companies with the same PE ratio, but if one has double the growth than the other, you'll come to the same result. That is what you call price to earnings growth, taking under the consideration the PE ratio of the company and its growth rate to see what it will be worth in the future. All we're really doing is making an educated guess on how much the company will make in the future. That's why it's essential to select stocks and companies that have a positive growth rate regardless of PE ratio, because you don't want to hold on to a company that is losing money, aka owning quality stocks at a discount. Warren Buffett's go-to method of selecting stocks. I hope you all enjoyed this little educational tidbit. That is a very simplistic breakdown of how to find companies in the stock market. It does help to have some sort of understanding of the underlying business you're investing in. The more insight you have, the better. So last week I had holdings in 6 different stocks: HOV, Hovnanian Enterprises, ZIM, ZIM Integrated Shipping, YMAX, YieldMax Universe Fund, BRKB, Berkshire Hathaway, HLF, Herbalife, and ESEA, Aeroseas. I trade them all for a 100% holding in Crocs. Crocs, the reason being is because they are going through an absurd growth right now and they are extremely undervalued. Also, I'm a big fan of their winning product, their Croc, which I'm sure you've heard about. My family has been wearing Crocs for years, and I currently wear them at a day-to-day basis. I doubt the company will be going anywhere soon. They are here to stay. If you enjoy my little breakdown on how to value a stock, then please like and subscribe.